Hi guys, I hope you people are doing well. So welcome to this session of the AFM. Uh, Let me just tell you the agenda for the session of today. I have taken out some questions which I think that if we practice those questions for the AFM, they're going to be a comprehensive revision of the majority core areas of the AFM syllabus. So I've taken out some questions and what I would be doing is that I would be conducting 6 sessions of the AFM practice in which I would be discussing those questions with you people. So that's what the agenda of today and for the subsequent sessions is going to be. I would have ideally used the ACCA CB practice platform, but unfortunate thing is that with respect to the ACCA CB practice platform, these days it has become very unreliable. I tried to get access to it on several times, and I really understand that at times you would say that it's a sort of waste of time because at times it's working, at times it's not working. So the whole plan gets actually, you actually mess up the whole plan. So what I've done is that instead of using the ACCA CB practice platform, I'm actually going to be using some of the questions that I've extracted from the revision kit so that we could have an idea that, okay, how the questions come and how we'd be covering them. So I've covered a few of the questions, and what I'll do is that I'll just start off discussing those questions one by one with you people so that we could just take them forward and we could just try to do them. So there is a complete set that I've actually prepared, and what I would be doing is that I would actually be solving those questions so that we could we could actually do and we could actually understand that how this whole is going to be done. So the first question that I'm going to go about is called Parafuels Company. It is one of those questions which was being tested in the September 2022 examination. Okay, you want to get the questions? Just a minute. Huh? Okay, just a minute. I'll just share them. Okay, I've shared them. Probably you will be just getting it now. Okay. Well, no, not enough, but they're good questions. So let's just start off. The Parafuels Company. It says the following exhibits available on the left-hand side of the screen in the CB examination provide information relevant to the question. So there is this Parafuels Company production facility replacement, the traditional technology investment A, new technology investment B, comments made at the BOD meeting. So these are some comments, these are some things that have actually been mentioned in this question. Now it says the information you should be used to answer the question requirement within your chosen response options. Now let's move a bit forward and let's talk about the requirements of the question first before we go on to do anything. So the requirement of the questions, there are multiple requirements. One of them is explain why Parafuels Company might include the value of potential offer from Caro when considering investment B. So they are asking you that why they would be considering a potential offer, not a confirmed offer, the offer that may arise when you are going to be considering investment in B. Prepare a report for the BOD that calculates the estimated net present value of the investment A, calculates the estimated net present value of investment B before taking into account the potential offer, and estimated NPV after taking into account the potential offer. So like 4 marks, 9 marks, and 9 marks. So it's like 22 marks. It says in the computer-based examination, the BSOP calculator will be provided to help you answer this question. So what we are just going to do is that we're going to define the variables of the BSOP calculator. I was just going to come on to that as we move forward. And then there are some other requirements also. So what I'll just do is that I will just copy these requirements, few of them. So that's one of the requirement. And this is the second requirement. Walaikum Assalam, Hassan, how are you? Okay, Hassan, I'll try to check it after the class, inshallah. Okay, now see. It says explain why parafuels might include the value potential offer from Caro in your investment appraisal. Now, first of all, can you people just go through this specific area? Exhibit number 1. Can you take 2-3 minutes to go through it? Okay. Now it says Parafuels company produces paraffin from crude oil, which is refined for use as jet fuel. For many years, Parafuels was private company, but it listed 3 years ago and now has a wide range of diverse shareholders, including institutional investors. Okay. Parafuels has a number of production facilities, and one of these is coming to an end of its productive life. Parafuels BOD is considering two alternatives. The first one is replacing this production facility with new production facility. So they actually have a production facility, and what are they trying to do? They are trying to actually, I mean, the facility is coming to its end now. So when the facility is coming to its end now, so what are they trying to do? They're trying to actually replace it with the new production facility. That's one, which will be modern and largely environmentally friendly. This facility will continue to produce paraffin from crude oil and is based on traditional technology. So there's a traditional technology, and that's what is going to happen. The second alternative is based on converting household waste into paraffin using new technology and has the potential to dramatically reduce environmental damage caused by air traffic. BOT thinks it may be beneficial to convert production facility based on new alternative instead. There's a lot of uncertainty surrounding this investment. A competitor, Caro Innovations, has suggested it may purchase the new alternative production facility at the end of the first 3 years of the investment. Details of production based on both the traditional technology and the new alternative technology are given in Exhibit 3. It is anticipated that both investment in A and B will have a 25 years life, whereas the cost of capital is estimated to be 12%. Now see, what happens is that the question's requirement is why they might include the value of potential offer from Caro Innovations when considering investment B. Now, there's something you need to understand, which is while undertaking the projects, the real life options that may exist should also be considered while making decision to invest or not. So when you have to decide whether you should invest or whether you should not invest, so what you should do is that you should actually consider the real life decisions also. Now, what do I mean by real life decisions to be considered? Let's try to understand this. The investment in the new technology may or may not have a positive NPV in isolation. But if but if there is an option to divest after a certain number of years, then the benefit arising from such option shall also be considered and a net investment be made. The fact that the competitor would be interested in buying the technology at the production facility after a period of 3 years create after a period of 3 years create a real life option to divest, and its value when considered will give a clearer picture of whether it is worth investing in the project or not. So you see what happens is that if you invest somewhere and you think that you have a exit value applicable, you think that you're gonna get a price for the time of exit, then you should try to consider that. Should try to consider that. Let's move a bit forward and let's talk about the second requirement of the question, which says prepare a report for the board of directors, which estimates the NPV and so on and so forth. Let's try to understand that. Let's try to see that. Okay. Now, if I try to see that, we have to estimate the NPV using the traditional technology. So if you could just read through it and try to do some calculations for the NPV. I'm just going to zoom out for 5 minutes and see what you can just gather the information. See what information you can gather. Okay, it was like when the previous requirement, when we were reading through that, so there was actually an offer to sell, the offer to sell. So whenever there, I mean, like there are four types of real life options. One of them is option to expand. The second one of them is option to delay. Third one of them is option to dispose of. And the fourth one of them is option to redeploy. So these are the different types of options. Okay, now let's just see. So basically, this question, because you see, we have to do the NPV calculation. Let's just try to see that what is going to be the NPV calculation here. The following information relates to investment A, where Parafuels continues to produce paraffin from crude oil using traditional technology. The initial investment will be 14 million. Tax allowable depreciation is available at an annual rate of 25%, reducing balance in years 1, 2, 3. At the end of year 4, any remaining written down value can be written off as balancing adjustment. As with production facilities of this nature, there will be no residual values after 25 years of project life because of substantial decommissioning costs. Now what actually happens is that sales revenue in year 1 is expected to be this much, and this is expected to increase by 5% per year in each of the years 2 to 4. Production costs are expected to be this. The pre-inflation amount for year 2 to 4 are given below. It is anticipated that the working capital of 10% of sales revenue will be needed in year 1 to 4, and that no additional working capital will be needed in year 5 to year 25. At the end of 25 years, it is expected that working capital will be required for decommissioning costs and will not be released. Parafuel pays tax at 20% on profits in the same year in which liability occurs. Tax losses is refunded in the year in which tax losses occur. Estimate has been made of discounted value of post-tax cash flows from year 5 to 25, and this totals 5.4 at the start of year 5. At the start of year 5. Now let's just try to do this. Let's just try to do the calculation of NPV. The net present value calculations for traditional technology, the net present value calculations for the traditional technology. So now what else is there? This is basically, here we have got sales is expected to be 12.75, and this is expected to increase by 5% per year in each of the year 2 to 4. Sales revenue. So this is how the sales revenue is going to be year 1, 2, 3, and 4. The production cost. I just need to check one thing if he has given the time period for which the cash flows are being shown. Okay, he has not mentioned anything. $5.25 in year 1. We would say minus 6.2 into 1.06 power 2, because you would have to incorporate 2 years inflation. I've just copied the values because I'm just going to change it now, 7.1 and 7%. So it's 7% and it's 7.1. Then you've got 8 million, and this is 8%. Okay. There's an error on my part. I want to rectify that. This is okay, but this one is not okay. 1.06 was the inflation in second year and 1.07 was the inflation in third year. First year 6%, second year 6%, because for first year we're not being given anything. So I'm just assuming that it's 6% in year one also. Third year 7%, fourth year 8%. So you could just see that how I've incorporated the inflation. Do we have any fixed cost here? Apparently no. So we need to incorporate the depreciation, and depreciation is, okay, let's just say the tax expense at the rate of 20%, right? So SN, you are ignoring the first year inflation. You're ignoring the first year inflation. You're not assuming that it is a first year inflation. Or you're assuming that these are being given at the year one levels. This is what you are assuming. What is your assumption in this? Okay. Okay, I'll just go about with this assumption also. I'm just assuming that these figures are given at the year one levels. So there is a profit before tax. In fact, depreciation slash balancing allowance. So it was supposed to be 14 million multiplied by 25%. And with respect to the year four, okay, so this is what it is going to be, the depreciation of the balancing allowance. The profit before tax is gonna be this. The tax expense at the rate of 20% is gonna be then the depreciation slash balancing allowance needs to be added back. After this, what are you gonna do? You're gonna say investment. Okay, balancing allowance not clear in year four. Let me just guide you. See, the cost of the asset was 14 million. Accumulated depreciation year one till three. was equivalent to this one. So the balance net book value is this 5.9025. This is called balancing allowance. Means it's actually like this, that you say that out of the total cost of the asset, this is the balance that is left. Now, so you will actually say that investment 14, the residual value is nil. Then lastly, there is this working capital which is needed. And it actually says that the working capital needed is 10% of sales revenue will be needed in year 1 to 4 at the start of each year. And no additional working capital will be needed in the year 5 to 25. So what actually happens is that for the working capital, I would just do a separate calculation. So here, sales, working capital, and then you have to calculate the incremental working capital. So here 1, 2, 3, and 4. The sales figure are gonna be this. The sales figure are this, and this. The working capital at the rate of 10% is needed. The incremental working capital that is going to be applicable here is this. Hence, what's going to happen is that the working capital of 12.7, 1.275 is applicable here. Then additional is applicable here. Then additional is applicable here. Then additional is applicable here. Then you've got the cash flows. Hence, the cash flows are going to be like this. So these are the cash flows that we have. Now what actually happens is that the discount factor is also given in the question, right? Are we being given the discount factor? Here, 12%. Working capital is always applied at the start of the year. Net present value is equivalent to so 1.67 million is your net present value. 1.67 million is your net present value. Now, I'm just waiting for you people to actually go through it and just ask whatever questions that you have so that I'll move forward then. Just ask whatever questions that you have, so I'll move forward then. The answer is not this. There is few more things that need to be added up. There are few more things that need to be added up. This is not the final answer. This is not the final answer. You discounted the investment in year 0 to, okay, the discounting impact will be 0 Because you see, even if you discount it in the year zero, it should not be in the bracket. Okay. Let me just see. Thank you for highlighting if I've made an error. Okay, yes, you are right. It should not be there. Thanks for highlighting this, huh? Thanks for highlighting this. So you see 12%, the cash flows that are to be discounted is year 1, 2, 3, and 4. And then you got to add up the year zero, the discount factors to be added up. So hence resultingly, this is what you'll get. You'll get the NPV like this, 1.87 million. Now add the present value of year 5 to 25. But you know what? This is at year 5 level. This is the amount that is given. It is actually given at the start of year 5, right? So what do you need to do? 5.4 multiplied by 1.12 power minus 4. Hence, resultingly, what happens is that $5.30 is the total net present value of first option. Do people get it now? Yeah, I've used the fourth year discount factor. So you got to use the fourth year discount factor because this is at the start of year 5. Okay, the working capital is not released because the examiner says that the decommissioning would require ample amount of money. So the working capital won't be released, won't be recovered at the end. The examiner says it very clearly in the question. Let me just see. See, it is expected working capital will be required for the decommissioning and will not be released. So that's why we have not released the working capital. Yeah, is there any other question on this, please? Any other question on this, please? Okay. The last step is C. The examiner has given you that the cash flows will be this much from year 5 to 25, and this is at year 5 level, at the start of year 5. That means at the end of year 4. And we need to take it to year 0 level. So you have discounted it using the year 4 PV factor. Do you get it now, Asan? Do you get it now? Okay, lovely. So we have been able to do this for the traditional technology, the net present value calculations. Now let's move a bit forward and let's talk about the new technology, which is investment B. Can you just try to do this one, please? Yeah, please give it a try. This one. Okay, sure. I'm just gonna guide you. Don't worry about it, Hassan. I'll just confirm that in a while. जस भाई पढ़ लेना, वहीं पे बैठे बैठे पढ़ लेना यहीं पे। मैं वेट कर रहा हूँ ऐसे भी 2-3 मिनट। Okay, now let's just start off. So it says that currently the new technology used to convert household waste into paraffin is expensive, and to set up and run, all those setup and running costs are expected to reduce once this technology becomes established. Initial setup costs are estimated to be $34.6 million. Due to high costs and lower revenues initially, the after-tax free cash flows generated by investment are expected to be 1.4 in year one. They expected to increase by 40% in each of the year 2 and 3. In year 4, when costs reduce and revenue increase, the after-tax free cash flows are expected to be twice as much as the year 3 amount. Okay. Due to high level of uncertainty with investment B, it is expected that annual after-tax free cash flows from year 5 to 25 will remain the same as year 4. Okay, so year 5 to 25, it's going to remain the same. It is possible that this is an underestimate, and in future more realistic amounts can be determined. The annuity factor for 12% cost of capital based on a useful life of 25 years is this. Caro Innovations has suggested it may offer to purchase investment B at the start of year 4 for $27 million. Due to uncertainty surrounding this investment, the cash flows are expected to be this. The risk-free rate of return is this. Now let's just try to understand this. First of all, we are not considering the Caro investment offer 0, 1, 2, 3, and 4. The after tax free cash flows are expected to be 1.4 million in year 1. They're going to be 40% in year 2, increase by 40%. Then they're going to increase by 40% in year 3. And then that's going to become 2. That's what it is going to be. Okay, the investment is going to be 34.6. The investment is going to be 34.6. So what is the investment going to be? It's going to be 34.6. Okay, so is there any residual value that is expected? We just have to ignore the Caro Innovations offer right now. No residual value, right? Okay, so all that you're going to do is that you're going to say, okay, the cash flows the net present value is going to be 12%. Okay, so your net present value is going to be, your net present value is going to be 26.35 negative. Then you would say present value of cash flows, you have 5 to 25. Now, how would you go about doing that? So we are being told that the cash flows are going to be remain the same as year 4. Now see, just try to understand. Basically, the cash flows are coming from year 5 till 25. Is that? We've been given annuity factor of 7.843. "25-year annuity factor is 7.843 less 4-year annuity factor less 4-year annuity factor." Should get 5 to 25 annuity factor now. So how would you go about doing this 4-year annuity factor? You would say 0.12. Okay, hence what happens is that 4.27 is gonna be the annuity factor for year 5 to 25. Now what you're gonna do is that you're gonna say year 4 cash flows multiply by this. So this is year 5 till 25. That means this cash flow is standing at time period 4. Then multiply by 1.12 power minus 4. Hence 11.45 is gonna be the net NPV. Is this incorrect or what? Is this incorrect? Is this 3.57 incorrect? Okay, yes, thank you. It's incorrect. Thank you, it's incorrect. Right? I put in the incorrect formula. Now, anyways, so this is basically the 4-year annuity factor that's minus. So next, 5 to 25 annuity factor. Now this 5 to 25 annuity factor is gonna be multiplied with the year 4 cash flows, and then you have to multiply it by 1.12 power minus 4. It's the same. It does not actually matter actually. So 9.59 is your net present value without offer. Without offer. 9.59 negative is your NPV without the offer. Now for the offer, what do you need to consider? The BSOP calculator needs to be used. Now from the BSOP calculator in the examination, you got to know what is PA, you got to know what is PE, you got to know what is going to be the R, you got to know what is S and what is T. So PA, he says it may offer to purchase the investment at the start of year 4 for 27 million. 27 million. The PA is the sum of the present value of all these. Now, what we would have to do is that in order to calculate the PA, you would have to say, okay, these cash flows. One, two, three, and 4. Hence, this is gonna be this into this. Okay. So the PA is gonna be we're not multiplying with 1.12. We're just saying 1.12 power minus this. This is the discount factor. The R is the risk-free rate of return, which is 5%. The S, which is the standard deviation, has to be 40%. And the T is the time period for. So basically, for the BSOP calculator, you would input all of this. I paid for the BSOP calculator, you would input all of this. Okay, for this one, see, they are arising at time period 4. They are arising at time period 4 now because it's from 5 till 25. So if it's from 5 till 25, so what you need to do is that you need to bring it to year 0 level. That's why we are multiplying it with 1.12 power minus 4. Okay, so the requirement of the question was that you had to consider the recommend whether investment A should be undertaken and discuss assumptions made in the calculation. This should be done prior to discussing the comments made at the BOD meeting. Discuss comments made at BOD meeting and suggest how parafuels may wish to proceed if the new technology is adapted. Now see, I'm not using the BSOP calculator here. I don't have the BSOP calculator. It's in the ACCA CB practice platform. Unfortunately, not able to access it, but I'll just share a video with you. So you just need these in order to incorporate the BSOP calculator. Now it says based on financial grounds, recommend whether investment A should be undertaken or investment B should be undertaken. So with respect to answer for number 3, investment A should be undertaken as it is a positive NPV investment. There are certainties to the cash flows. With B, there are too many uncertainties. Assumptions. Now, with respect to the assumptions, just consider the assumptions that are made. The sales revenues are expected to meet the growth rate plus the production costs are quoted at year one price levels, the inflation rates are expected to prevail. Cash flows for year 5 to 25 are highly likely to be arising. The discount rate of 12% is the best estimate of the risk attached to the investment. So see, what happens is that you'd have to talk about this. Okay, see, one of the requirement based on finance recommend whether A should be and discuss the assumptions made in the calculation. This should be done prior to the sales revenue expected to meet the growth rate. Now, then what you would do is that you would do some critical evaluation over here. This seems to be unrealistic as based on current performance. This may not always be the case, as with the new technology, the existing rate may not be a reliable estimate. So what you need to do is that you need to actually assume, I repeat, you need to actually assume that because a lot of the students, they get stuck with respect to assumptions and all that. So the simplest thing is that just quote the assumptions that are being given in the question and just try to comment on them a bit. That's it. Yes, we should ideally be using the risk adjusted rate. Next, it talks about the comments made at BOT meeting and suggests how it may wish to proceed if the new technology is adapted. So can you just try to take out some pointers out of this? Yeah, can you just try to take out some pointers out of this? Now, Parafuels BOD met to discuss adapting the new technology for its production facility replacement based on converting household waste on paraffin. The following comments were made. The company CEO gave an enthusiastic talk about the need of parafuel fuels to fulfill its ESG responsibility. The CMO pointed that it is likely that airlines around the world will face increasing pressure on the ESG agendas, and in particular how they are helping to protect the environment. Our CMO also said that airlines will need to ensure that this type of fuel is safe to use. Now, what is the requirement of the question? Discuss the comments made and suggest how parafuels may wish to proceed if new technology is adapted. The ESG comments by the BOD. The adoption of new technology would help achieve ESG objectives. We need to do what? We need to discuss the comments. This will enhance the image of the organization. However, the safety of the fuel for usage, if not ensured, could lead to severe reputational damage. The overall, this could lead to enhancement of the image of the organization if it is managed well. That's number one thing. What's number two? It says the CFO was more cautious. She pointed to the fact that there is no binding contract with Caro Innovations. She also said that while Parafuel shareholders would be supportive of the company pursuing an environmental agenda, the majority of shareholders will be concerned if that led to a significant negative impact on the corporate value. CFO reminded BOD that although only one production facility needs to be replaced very soon, more will be needed to be replaced after 2 years. Now, the offer from Caro, what was Caro? Innovations is not binding and could have a significant impact if such offer is not made. The shareholders' overall goal and objective is the maximization of shareholder wealth. If shareholders' goals are not met, they may not even allow the existing management to continue. This could be a serious threat to the board's presence. So need to consider that the major shareholders are taken on board before undertaking any such decision. In case if they are able to become experts in the use of this technology. This would lead to significant savings for the future. Nevertheless, CFO suggested if this new technology becomes established and produces jet fuel which is safe to use, Parafuels will get the benefit of being one of the first companies to adopt new technology. Uh, okay. The risks are involved, but could be an opportunity to be the market leaders in this new fuel. So does it require us to conclude also? So overall, before adapting to this new technology, the safety of the product needs to be ensured. Shareholders' consent needs to be obtained, and a clearer explanation given to the shareholders about this. This is what you will have to consider. Well, Ijaz, it's actually not like how many pointers need to be done. It's like how many relevant points you're going to talk about, right? It's not just like the number of pointers, each pointer 1 mark. No, no, no. It's not like this. It's about, given the scenario, how much sense your discussion is making. It could even be 2 marks per point also. Okay, lovely. So I hope that it was, and yes, these points are okay. Shahir Kareem, I'm really happy to see that you are contributing, mashallah. This is really good to see. Okay, so we are done with this question, and what I'll do is that I will conclude the session of today here. We meet up inshallah day after tomorrow, and then inshallah what we would try to do is that we would try to do 2 questions in that sessions. I hope that the session was beneficial to all of you and that you enjoyed the session today. Okay, Hassan, need not to worry about small things, right? Yes, the recordings will be shared with everyone.